Boop boop bop ba dum bum. Boop boop bop ba dum ba da dum da dum da dum ba dum bum. Beep bop boop bop boop bop boop da ba dum bum. Beep bop boop bop beep beep boop bop ba dum bum. Hello, ladies and gentlemen, and thanks for joining us. As promised, we're going to have a discussion today on stock valuation. This is probably one of the more complicated subjects that we've attempted to address, and so we'll try to keep it as simple as possible. We will go through, in fact, one example, and I think we can get to it and all of it in the time that is permitted. You see here behind me a bunch of equations. I put them up there not only am I going to use them in the hypothetical that I'm going to use, but also to sort of point out the factors that affect stock values from more of a mathematical perspective. And in that sense, the numbers don't lie. The interpretation of the numbers may not be faulty, but numbers don't lie, at least in terms of the relative increases and decreases in valuation. But what I think you should, the major lesson that you should learn from this is, however, that despite the fact that we have all these fancy formulas out here, that we have to remember that so much, in fact virtually all of it, depends on speculation and projections and hopefully educated guesswork done by a lot of times some very smart people, very well-intended people, but nobody has a crystal ball. That having been said, we're dealing with stocks that are traded on the New York Stock Exchange or over the counter or NASDAQ or what have you. Okay, so let's get right down to it. Traditionally, let's start with the simplest. I've got this equation up here to begin with, and the PO, the little cap one there, is the expected value of today's stock price. That's the expected stock price today. That's what our calculation is going to be as to what the intrinsic value of the stock is going to be if we buy it today. Now you'll notice that the first number here is D1, that's dividends. As you know, owners of common stock can get dividends during the year if the board of directors declares them. As we discussed in an earlier video, they don't have to declare dividends. Now, once they start declaring dividends, normally boards of directors don't like to cut the dividend or skip a dividend, but they don't have to declare the dividends. So that obviously creates some interesting issues with respect to this formula, but that is sort of the easiest formula to sort of get our hands around, and it's a valid formula. Anyway, today's price is dependent on the first years, this is D1 is the first year. This is today. PO, this is 0 is today. This is 1 year, 2 years, 3 years. All right, so this is 1 year, 2 years, 3 years, 4 years, etc. Now, I just want to tell you that, first of all, I don't know how many of you folks are familiar with present value concepts, but let me just say one thing. I think it goes without saying that if you had your choice of getting $100 tomorrow or $100 100 years from now, you would rather have the $100 tomorrow. Believe it or not, in finance, they have ways to value what the differential is in the value of getting $100 100 years from now versus getting $100 tomorrow. And it's called present valuing. PV is in finance is the abbreviation for present value, and future value is what it is and how much it is in the future. Now I'm going to show you what, because the value of a stock is theoretically dependent on its future dividends, that's this formula up here, or its future free cash flows, that's FCF, free cash flows, okay, free cash flows equals FCF, okay, so if you added up all the future cash flows, that gives you what that should be encompassed in the value of the stock price today. Here's the problem. Like I said, $100 100 years from now is worth a lot less than $100 tomorrow. So if the dividend was $100 100 years from now, it doesn't add $100 to today's value. As a matter of fact, to show you how stark this is, $100, I did a calculation. If we used a required rate of return, a discounting factor of 10%, $100 100 years from now is literally worth $0.00726 in present value in today's terms. So it's not even worth 1 cent. It's worth 3/4 of a cent. So that just goes to show you. So basically, the real relevant numbers in terms of the dividends to figure out stock price occur closer to us on the time horizon. And that's basically the reason right there. Okay, this is the simplest model. For example, and you'll notice that it's the dividend over the required rate of return. This is the required rate of return. Now, this goes to the issue that if you buy a treasury bond, it's guaranteed by the federal government. In order to induce you to purchase that bond, this federal government's only going to have to pay you, right now 3 or 4 or 5%. Not even 5% right now, but 2, 3, or 4%. Okay, but that's what's known as the risk-free rate. That's RRF. This number right here is sort of the crucial number for any particular stock, because this is what's known as the risk premium. So if treasury bonds, or let's say this, if T-bonds are paying 10%, that's the 10-year treasury bond is paying, we'll say it's paying 5%. So that would be that number. And then there's a risk premium because your particular company, let's say it's a fairly risky company, well, let's say the market risk premium for stock, for an average stock that moves in conjunction with the stock market is another 6%. That's the risk premium. That's this number right here. Let's say it's 6%. So we would take, to figure out the required rate of return, it would be 5% plus 6%. But then you'd have to figure out this item here called beta. And that is market risk, okay? That is systematic risk that can't be diversified away. Anyway, don't get panicky by these terms yet. But anyway, let's say that your stock is more, average risk would be 1, okay? So it wouldn't do anything to this equation. But if your stock is twice as risky as the market, beta would be 2. It's twice as risky. So this number would be, the required rate of return on your thing would be 5 plus 12. The required rate of return on your stock, if you were twice as risky as the market, would be 17%. And that 17 would go right in there in that equation. Okay? But we see, by virtue of that, a couple of things. Number one, the rate on your stock is the required rate of return on your stock is going to be very much influenced by what the Treasury, U.S. Treasury is paying on its bonds. That's number one. Number two, how risky your stock is relative to the average risk of the stock market generally. Those two things. I mean, if you're a riskier than average stock, you're going to have a higher beta. If you're a less risky stock, maybe you're a utility or something like that, instead of having a beta of 1, which would be average, you might have a beta of 0.7. Okay? All right. So the point here is that if let's say in this thing, if the first year's dividend, let's say if it was, let's say the first year's dividend in D1 was $20, okay? And let's say that it stayed, and let's say there was no growth rate, that it stayed $20 forever. If it was $20 forever. And let's say the required rate of return was 17%, 0.17, and if it's $20 forever, and it doesn't change, that means the G is 0. So the value of that stock is 20 over 0.17, whatever that is. Let's see here. Well, all right. Value of that stock would be, by my calculation, $117 per share. But now look at what's happening there. Somebody has got to forecast what the dividends would be into infinity, and the board of directors is not even legally obligated to declare those dividends. And by law, a company's not supposed to declare dividends if it's losing money. It's a little more complicated than that. They can, under certain circumstances, declare dividends if they're losing a little bit of money, but that's a complicated subject. But the point is that basically the analyst has to predict how profitable the company is going to be forever into the future before he can come up and compute under the standard formula used by financial analysts what the stock price is going to be. Okay, so that obviously raises a lot of conjecture as to what is the value or what's going to happen in the future. Obviously, there's a crystal ball involved. But let's suppose we decide we can't use this model because the board of directors has a policy of not declaring dividends, and all they do is reinvest their profits. How do you value the stock then? Well, obviously, although there is a way to use this, I'm not going to talk about that today. Let's rely on this other formula. This is a more complicated formula, but it's more precise, and it allows you to depict what's happening more readily, and for that reason is probably a superior formula. Incidentally, when G is 0 in this formula here, this is the formula for valuing any annuity. That's called an annuity. A periodic payment over a required rate of return is an annuity calculation of value formula. And that, if there's no growth and a steady dividend forever, the value of the stock is basically the value of an annuity paying the same amount as the regular dividend is. Okay, all right, so, all right, so anyway, so we're going to talk now about a situation. Let's, okay, that's free cash flow. Do I need this? Let's see, I don't think I need this anymore. I don't think I need this anymore. Alright, so this is the price. Yeah, this is the price now. Okay, and also under this model, this becomes the total value of the company. TVC stands for the total value of the company at time 0 right now. Time 0 is right now. Okay, here's our hypothetical. EBIT is earnings before interest and taxes. It's sort of a type of, it's a little higher up on the income statement than net income is, but you can sort of think of it as how much the company has earned. And in this formula, it's EBIT. Free cash flow is basically your profitability after taxes, right? But for reasons that are beyond the scope of this discussion today, you add back in depreciation because that's a non-cash expense, and we want free cash flows. You add back in depreciation, and you subtract out any required increases in capital expenditures and in your working capital that's necessary to generate this free cash flow into infinity. Now, obviously, you've got to know, do you know whether you're going to buy a car in 2 or 3 years? Do you know whether you're going to buy a house in 5 years? Do you know whether you're going to sell your house in 7 years? Are you going to buy a boat? Well, some financial analyst has to predict all this stuff into infinity, into the future, to figure this number out. Now, the analysts follow these companies in depth. They only follow a few of them at a time. And so they know these companies, but my point being is even you yourself, and presumably you know yourself, you don't know what you're going to do in 2 or 3 years to try to predict what your job security is going to be or anything like that into the future. So you can see that despite the fact we have these marvelous financial formulas, these mathematical formulas, which from an accounting and finance standpoint make perfect sense, they are projections into the future. Notice that I've got over here, we expect in the first year, in other words, between here and here, right? For this period right here going forward, we expect earnings to be at $400,000. We expect our tax rate is going to be at 25%. We expect that the depreciation for that first year is going to be $20,000. We've got 100,000 shares of common stock outstanding. CES is common stock. We expect an increase in working capital both. That's an aggregate figure of $50,000 in the first year. WACC is weighted average cost of capital. That's this number up here. Now I just want to tell you that this number, we talked about how related the required rate of return here was to the Treasury rate. Remember we talked about the T-bond rate. Well, this formula is too. It's just not quite as apparent. This RS here comes in basically over into here. So the relationship to Treasury bond rates and market risk premiums and all that kind of stuff is very much in beta. See, all that's in here, and you can sort of go from here up over into here. But WACC sort of serves the same function in the equation we're going to use now that required rate of return did in the dividend model. Okay, we're using the free cash flow model. One other thing I want to basically point out is, I don't know how, this is a balance sheet right here. You have assets over here, right? That's the property you own, and over here you have liabilities, and then you have equity. This is common stock, preferred stock, okay? Preferred stock. And then you have retained earnings, which is the amount of money in the company that you've earned through operations. Okay, I'm just going to throw that in, and this side is, these sides are supposed to equal to each other. Okay? All right. The asset side is supposed to equal liabilities plus equity. All right, but anyway, so here's what we're going to do. So you can sort of look at it this way. When we calculate this number, this is an easy way to conceptualize it. This is the total value of the company side over here, and this is accounting for it. See, common stock, preferred stock, real estate, and here's the liabilities. These are debts, right? So that's what we're really trying to do here, okay? Now these aren't, we're not talking about accounting values here. We're talking about the market value of the company. What, if you added all of its common stock together at market prices today, what the value of the company would be. That's what the TVC is. Okay, so in any event. So let's take this thing here. So so if we try to figure out the free cash flow from the first period, period 1, free cash flow from period 1 equals free cash over WACC equals the total value of the company, right? Okay, so we're right here. So if we do this like this, I'm using this formula. This equals free cash flow in 1. We got to figure EBIT first, okay? So free cash flow, this is in period 1. So free cash flow in this case is going to equal to 400,000. That's our EBIT. 1 times 1 minus 0.25, because that's the T, tax rate. This is T, right? Okay, that's the tax rate. Plus the depreciation. I'll tell you what. Let's take out, we're going to assume for the sake of argument that there's no depreciation, okay? We would add the depreciation in, but we're going to assume 0 here. Okay, and then we subtract out capital expenditures, that's this part right here. All right, so this is, all right, we'll keep it. We'll keep it. 20. Yeah, all right, depreciation. We would add it back in, but we're going to assume none. Depreciation is 0. Let's see here. Okay, 50. How much? Capital expenditure, working capital is plus 50,000, minus $50,000. So that number is equal to that. Everything in that brackets there. So this means the free cash flow here in period 1 equals $250,000. So it would be like right here, this number here would be $250,000. Okay? All right. Now, our formula assumes $250,000, but our free cash flow is going to increase every year by 5%. So this number here is 1.05 over 2 times 250,000, right? So this would be if that would be this free cash flow. Let's see, 1.05 times $250,000. So this here would be $262,000. Okay, but actually we don't even need that number, but I just wanted to show you, and this would be FCF3 would be 5% higher than FCF2, FCF4 would be 5% higher than FCF3, but we don't even need to make all those calculations, interesting enough, right here, because all we need is FCF1. That growth rate is going to be taken into account down here without any further calculation. So here we go. It's what did I say? I said this is going to be $250,000 divided by. I said WACC was 10%. We convert that to a fraction. Okay, that's WACC. And this is 0.05. 0.05, 0.10, so we got 250K divided by 0.05 equals, all right, where is it here? This actually should come out to $5 million. Okay, all right, so that means the total value over here is $5 million. But we only want to figure out what the value of the common stock is. We're not going to assume there's no retainer. All right? So we have got to take out total value of the corporation. Now we're going to switch equals total liabilities which is 1.2 million. Okay, plus, there's no preferred, 0 plus 0 plus the common stock value, okay? So, and over here we've got 5 million. So, this is where we are right now, right? So 5 million equals 1.2 million plus a 0 plus whatever the common stock is, value. All right, so this is going to be, what is it, 3.8, is that right? This means that the value of all of our common stock is $3.8 million, okay? If we want to know what the value per share is, we've got 3.8 million divided by 100,000 shares outstanding. That's this number right here. So this would give us $38 per share. That's the value of the common stock right there. That's the common stock per share value right there. There's the answer, 38 bucks a share. Okay, so let's see here. How are we doing on this? All right. Okay, well, unfortunately, I don't think we have much more time. In a future video, we're going to discuss ways to address this issue of risk, which creeps in right here, and how, despite the fact that there is so much uncertainty here, which makes it extremely risky, in fact, perhaps futile, to try to bet on which way individual stock prices are going, how a way that you can invest intelligently using the efficient market hypothesis and diversification. Thank you. I'm David Lentz.